This is a 506C investment opportunity for accredited investors only. We'll get into that later in the presentation, let you know what that means. And then also, we know you're going to have lots of questions as we go through this. So if you will just put the questions in the little chat box at the bottom, we'll be kind of keeping our eyes on those and have a few moments throughout the presentation to address those, as well as at the end. So just bear with us for a little bit. Jumping right in, we're going to talk about legal disclaimers. Of course, we highly recommend that you take the time after this to read through this whole page. There's a lot of great information there, but we all know that any investment has risks. As we go through this presentation, we're going to talk about the specific risks to this project, this property, and what we plan to do to mitigate that. But like I said, take your time going through it. Now, the exciting part, we get to meet the team. This team is incredible. Between all of us, we have more than 50 years of experience in various parts of the real estate industry, bringing all different kinds of knowledge. So we really are a well-rounded team here that we just love. And we also have about $350 million worth of assets under management between all of us. So this is not our first rodeo here. I'm going to pass this off to Lee, our team leader. Let him introduce himself and his wife, Megan. There are two Megans on the team. And then we'll go through everybody else.
Everyone, my name is Lee Fjord. I'm here with my beautiful wife, Megan Fjord, and we are going to be overseeing the asset management of this deal. We currently run over 700 apartments in 2 states, Missouri and Arkansas, former multifamily real estate broker, full-time multifamily real estate syndicators now. And yeah, we're good.
Yeah, and I am a Navy veteran. I served 9 years active duty in the Navy, made it to, I'm a reservist now, senior chief petty officer. Got out in 2016, got into real estate part-time in 2017, buying and selling. Always been into real estate investing and really dove into it in 2020. That was the year I met Lee, and we've been investing together ever since. So nice to meet everybody. Thank you for being here, and on to Joe and Shretta.
All right. Thank you, Megan. Good evening, everyone. My name is Joe Johnson. I've been in the real estate industry since 1997, both residential and commercial. With the main focus on the residential side, I am very excited to be rejoining on the commercial side of the industry. My wife, Shretta, and I moved to Atlanta, Georgia in 2004 and have been focused on the fix and flip model. We currently manage fix and flip properties in 5 markets. Our focus will be the boots on ground to oversee the CapEx improvement budget, with an emphasis on making sure that our CapEx improvement budget maintains integrity, transparency, meets all deadlines, and most importantly, each and every tenant will be proud and happy to call the Phoenix place home. Take it away, Charlie.
Hey guys, Charlie Peters. I'm a long-time real estate investor, owner, operator. Bought my first multifamily property in 1996. This will be my 30th apartment community. I am the lead sponsor and key principal on this deal. We're super excited about it, and you guys are about to find out why here tonight. Megan and Morgan.
Hey guys, Morgan Gonzalez here. As you can see in that picture there on the screen in front of you, Megan is my sister, and one person that's missing, we just don't have the picture of all 3 of us together yet, but my wife, Bethany, is also involved in this deal as well. Together we are MG Investment Ventures. Our role on the team here is the marketing managers and lead investor relations. I have a degree in advertising with a background in marketing, over 20 years in the real estate industry in different facets. We have a luxury residential real estate business that has taken us around the globe, and that's been wonderful. Also a longstanding background in the manufactured home, mobile home, modular, and commercial modular industry, as well as consulting on the buy and sale of RV and manufactured home parks around the country. With all that being said, our passion is obviously real estate. We live, breathe, and sleep real estate, and our first and foremost favorite part of investing in real estate is right here in the multifamily industry. It's absolutely wonderful. And I'm super excited to share this opportunity with you guys and hope you come on board and invest alongside us.
Hey guys, my name is Colby Carlson. I have been working side by side with Lee for a little over 2 years now. I jumped straight into doing real estate right out of college. This is my dream job. I live, breathe this stuff every single day. I also have the opportunity to work with my dad, Dave, and assist him in the construction management side of things and assist Lee on the asset management side of things. So, Dad, go ahead and introduce yourself.
Hi, guys. Thanks for joining us tonight. I'm Dave Carlson. Thanks, Colby. Best part about this is I get to work with all these rock stars and especially my son. That's an honor for me. Get to work with Joe from the NFL. So I know the NFL's kind of got my back. My background and on my piece of this is going to be asset management. I'll be helping Lee and Colby with asset management, and I'll be helping Joe with the construction management side of it. I have a degree in construction management and plus over 40 years of construction, building multifamily from the ground up, as well as a whole bunch of other projects, medical and all kinds of other stuff. So I'm looking forward to this, and we're glad you guys are here tonight. Take it away, Sam.
Thank you very much, Dave. I too get to work with my son Samuel. That's always a treat, Dave. So I appreciate that too. Samuel's been working with Lee and Colby on the underwriting, due diligence, property comps. So he's been knee deep on everything, working with the team. My background goes back 35 years in the construction business, building commercial and industrial projects. Samuel and I have worked together and doing flips in the past couple of years, and we enjoy the real estate markets. One thing that we really enjoy a lot of. My role will be a co-sponsor, and Samuel will be involved with asset manager on this team. Back to you, Lee.
Thanks, Sam. So we really want to cover something that's very important to us and brings the entire team together. That is our core mission. What do? We create value for everyone we work with. We purchase poorly managed, underperforming apartment complexes and improve and implement professional business practices to improve the living conditions in our communities and increase the quality of service provided to our residents. By transforming our apartment complexes into safe, high-quality homes, we drastically increase the value of our properties, providing substantial cash flow investment opportunities for our investors. Morgan.
Hey guys, take a look at this picture. This is an aerial view of our property here, Phoenix Place. 144 units spread across approximately 10 acres, 22 buildings on site, plus the leasing office. And it's an absolutely stunning property. But even better than that is I cannot wait to see what it's going to look like when we are done with all of our improvements there. This is a great value add opportunity for us and for you as investors. On the left side of that screen, you're going to see the QR code. I spoke to a number of you prior to this webinar that are ready to go ahead and invest. The investor portal is open and ready. You can go ahead and click that QR code and or scan that QR code, and that will take you through the process. It's very simple. We're going to have a few more of these screens pop up later. So if you didn't get it this go around, there's going to be other opportunities.
Presentation. So this is a multifamily apartment asset. We plan on doing a C to B class value add strategy with this complex. Again, this is a 506c syndication. We plan on doing a 70-30 split, 30% going to the GPs and 70% going to the LPs. We do plan on putting $2.25 million into this property, which is going to go a long ways and completely turn around how this property looks. Okay, we're picking up this property for $103,000 a unit, which is $14,875,000. This is an extremely, extremely good basis for this market. I want to emphasize how much of a discount we are getting this property at for this area. We're super excited for the price that we got it at, and there's more to come from that as well. The equity multiple, 2.05 to 2.25. Some of you are probably wondering what that really means. The equity multiple means for every dollar that you put in, you're going to be getting out $2.05 or $2.25. We're going to explain later why that's a range. We are placing fixed low-cost agency debt on this, and we plan on holding this property for 5 years. We're seeking $7.4 million to take this down, and you will receive an average annual return of 21 to 25%. And again, you will understand why that's a range later on in the presentation. All right, so this property is 144 units, and they are 100% townhomes. That is the best part about this property by far. They are not over-under units. They're side by side, meaning you don't have an upstairs neighbor and you don't have a downstairs neighbor. So you don't have to worry about, being too loud or whatever it might be for your next door neighbors. It is a huge value to the tenants that live there. This property was built in 1971 and is currently 91% occupied. We were able to negotiate with the current owner to put brand new roofs on the property by the time we close. So that will be one thing off of our plate. And when we receive the property, we will have brand new roofs on it. It'll look absolutely stunning. One of the cool things about this property is that it's extremely close to a lot of schools. As you can see there, it's a mile away from an elementary school, about a mile away from a middle school, and 2 miles away from a high school. These schools aren't just close by, they're also brand new. One thing to note is that not only are a lot of investors like ourselves placing a ton of capital into this market, but the city and the municipalities themselves are also seeing the value within this market and are placing capital themselves to really turn this market around. We do have 23 buildings. That is a typo there. We do have 23 buildings and 1 leasing office. And these are all electric units. And we do have a pool on site. The unit mix. Some of these units are really cool. The 1-bed, 1.5 bath, which is really unique. They are a loft style unit. So when you walk up the stairs, you can kind of see down into the basement. Then you have your bedroom and your closet and dressing room, all that good stuff. The 2 beds, again, are your townhouse style, your traditional over-under, with the bedrooms being upstairs and the living room and dining room being downstairs. And the 3 beds are by far my favorite floor plan. They're actually 3 stories, which is super unique in an apartment. They're really cool, super spacious. They're almost 15,000 square feet, or 1,500 square feet. I'm sorry. They're really cool layouts. So we do plan on targeting families for our target demographic. As mentioned before, there's a ton of brand new schools nearby. We do plan on putting a brand new playground on site. There is a pad for where there once was one, but we will be putting a brand new $30,000 playground in there. That when we were there on site, we noticed tons of young children that could utilize getting their energy out on that playground equipment. So super excited about that. Again, we do have a really nice swimming pool with really nice pool decking and nice pool furniture. We do have on-site laundry. The laundry room is very nice, very well kept. And we do plan on putting patios onto these units. So as mentioned, these units are townhouse style. So they have a back door, which is really great, but can also allude to some privacy issues. All of the units that are facing towards the street, we will be putting in a fully fenced in backyard to kind of provide the tenants with a little bit of privacy, and the ones that aren't, they're going to be putting spacers in between them. We'll talk a little bit more about this later on. Lee, back to you.
All right, so we wanted to give you an idea about what the current condition is of the asset. What are we acquiring for $103,000 per door? It's not just 100 or 144 townhomes. It's also the common area space, the green space at the property, which is very well kept. There's plenty of parking, almost 2 spots per unit, which is a great number of parking spots. And we are going to completely transform this property from where it is in its current condition, which, you know, from a physical standpoint is perfectly fine. The one thing that I see in this property that it has the greatest amount of flaws is the one thing that will be completely torn off and replaced before we close and purchase this asset. And that's all the old, outdated, end of useful life roofs. So imagine all of these real buildings that you see here having brand new roofs on them before we close, which will also help reduce our insurance expenses. Next slide. The interiors. The interiors of the units having amazing floor plans. These loft style 1-bedrooms are dope. I mean, they're really cool. You walk in and you have a 2-story living room space. And from the bedroom, you look down into your living room with a non-functional fireplace. These fireplaces are non-functional any longer, but every one of the units has a fireplace, which is actually pretty cool. Many of the units have already been updated by the current owner, adding vinyl plank flooring, black appliances, brushed nickel light fixtures, things that we will also be adding to the units that have already been updated, but we're also going to take the property to the absolute next level. So the current condition we feel like is right on par with what we would expect for this price point of $103,000 a door. But that's not what we're gonna do. What are we gonna do? We're gonna bring this property into the 21st century. I mean, this property looks like it was built in 1971 with new windows. I mean, if you look at the orange, oh my gosh, it's not appealing. So what are we going to do? We're going to modernize the entire complex by adding aesthetically a new paint job to the entire exterior, new parking lot. The one thing that I'm really excited about is the rebranding of this property. This property will eventually no longer be called Phoenix Place. Now, if anybody wants to add to the conversation and add a name that they'd like to rebrand the property into the chat, I'd love to hear what your ideas would be for the new name. We all have come up with our own. Eventually, we're going to come up with the final one, but it's going to be something new and modern, you know, and short and sweet and easy to understand. Nobody really knows what Phoenix Place even means. It means ugly orange doors, basically. Next slide. So, property upgrades from an exterior and interior standpoint. What are we going to do? We're going to close in yards on the non-private areas of the complex for those patios. When you walk out your back door, you look to your right and your left. Do you really want to see your neighbor's grill and their patio furniture? No, you don't want that. So as we've done on other properties before, we're going to enclose 1/3 of the rear areas of the townhouses, and we're going to add dividers separating and adding privacy to 2/3 of the units. We're going to go into 86 of the apartments and we're going to bring them up to a B class level. We're going to rip out the kitchens and we're going to add all new cabinet boxes because the current boxes in most of those units, at least all of them that we're going to be replacing, are in need of it. They're original. They're older than I am by 10 years. So it's time. And we're going to bring the interiors of these units up to a new standard. We're going to be doing new stainless appliances, new cabinets, new counters. We're going to be revamping the bathrooms with new light fixtures, new vanities, new shower walls, new shower valves, and just completely revamp the entire property in addition to changing the name. It's not just in the name. It's we want to provide an amazing home for our residents to live in. So the numbers, the sources and the uses. This is really important to get a grasp of where are we buying the property for and how are we acquiring the asset. So we are going to be placing a Fannie Mae large balance loan on this asset that is fixed for the entire hold period. There's no floating rate debt. There's no, oops, what happens if in this business plan. We're going to have fixed rate debt for the entire ownership, and we've estimated a conservative 6.25 interest rate that'll be, and a conservative 36-month period of interest only. The general partnership team, the people that you've heard from here so far, contributing $1.3 million alongside of all of our investing partners. So our money is invested alongside your money for a total source of 18.35. What are we going to do with that? We're going to buy the property. We're going to have closing costs and fees and reserves in order to hold the property. And then we're going to invest 2.5 million into it. All right. On to Dave to talk about the details of the CapEx budget.
All right, thanks, Lee. CapEx budget, I'm excited to get going on this one. This one's gonna be fun to dig into and bring up to polish it up to looking really nice. Exterior, as you can see, the asphalt in that picture, we've got money in there to upgrade the asphalt, polish that up, restripe everything. Exterior paint, all the exterior renovations, lighting, security, gutters and soffits, HVAC systems, concrete and handrails, power washing, just in general, pretty well polishing up the exterior as it needs. And then on the interior, you've seen some of the units already are pretty well polished up. We've got 87, I think Lee said 86, but we've actually got 87 units we're going to be upgrading and going through and putting LVP flooring, appliances, new countertops, tub and tile surrounds, and again, just really polishing everything up. I think one of the things that might not have been talked about was on patios. We're going to be putting in dividers on a patio, so adding some privacy and adding a nice little touch to the townhome style units.
Dave, real quick, talk about our due diligence period and how many contractors you had to develop this.
Oh, that's right.
Just,
I forgot to throw that in there. We were there for 4 days. We had over 40 subcontractors and the property management company we're going to use come through, and we met with them and walked the property from one side all the way to the other side. I know our DD team, we went through every single unit in the property. We looked at the structure, we looked at the sewer, we pretty much gave it a once over. And but which is how we came up with this budget that you're looking at too. All right, Sam.
Right on. Thanks, Dave. All right, let's get into the rent comps. During due diligence, I spent probably 2 days driving around, looking at 10 other apartment communities. And I'm like unbelievably stoked about what we're going to be able to achieve with our conservative projections. So this one right here is Stone Tree Apartments. It's the closest community within 100 feet of ours. You can see right here, they're getting 1335. They're 2-bedroom, 1.5 bath townhomes. Our current average rent for our 2-bedroom townhome is $1068 a month. So we're going to be able to bring this to a classic level, and we're going to be able to achieve $1275 a month, just over $200 more. For the renovated units, we're conservatively projecting $1350 a month. And from what you heard Lee talk about it, what we're going to be doing to these units is not going to look like those pictures on the screen right now. That's what Stone Tree looks like right now, right? They have no upgraded lighting, no flooring, no cabinetry, toilets, or updated appliances. It's very outdated. It's very bland. Ours is going to be in way better condition, especially with our CapEx budget. I know Dave's going to rock it for sure. You can also see, back in March of 2022, Stone Tree Apartments sold for $126,000 a door, and we're buying ours at $103 per door. That's $23,000 less. That delta right there, like, we've already gained so much equity right off the bat. Let's see, another community that's about a quarter mile down the way, they're getting $1515 per month for their 2-bedroom, 1.5 bath townhome. And they're doing the same renovation plans that we're planning for. So I think we're pretty stoked on that. As you can see on the graphs, we're also going to be able to bring our 1-beds and our 3-beds up as well. Because our property is majority of 2-beds, that's where we're going to be doing most of our renovation, being that that's where the money lies. So I think we can all say we're super, super excited about it.
All right. That was just beautiful. Guys, if you've heard enough, you're already excited because there's been a lot of exciting information going on already. You can go ahead and scan the QR code here. The investor portal is open and ready for you to go ahead and subscribe and start your funding process. I told you we would take a little break and see if we have any questions. One of them is, what is the time frame for the CapEx improvements? That's a perfect time actually to ask that, since we just went through the capital improvement budget. So Dave and Lee, you want to answer that question really quickly?
Go ahead, Dave.
So I'm gonna say we're gonna jump into it head first. And it kind of depends on the turns and the leasing and what's going on with the leasing side of it. But the turns, we're going to try and turn them as quick as we can. So I'd say I'd like to believe we could do this in 2 years or less. But we haven't really figured out the turns and how we're going to put it all together. But that's the goal.
One thing that I'd like to
add to that, Lee.
Yeah, one small aspect that I'd like to add to the conversation is that we have budgeted to add a minimum of 3,500 and as much as 16,000 into every single unit at this property. Many times you'll find investments like these where you have the ownership team skip over half of the apartments and say, we're not going to touch those ones. We're just going to leave those ones alone. But then they accidentally end up having 75% of the tenants turn over in the first couple of years because you're raising the rents by $240 per month. But we've actually budgeted for that. Right. And we've planned ahead, and we believe it'll probably take between 24 months and 36 months to transition 100% of the units from their current state over to being updated, remodeled, turned over, as well as do all of the exteriors. And the last thing we'll do is the parking lots, because we're going to have a lot of trucks driving around on that property, and we'll end up doing the full overlay parking lot after we do the interior majority of the remodel. About 2 years, 2 to 3 years total.
Beautiful, guys. Thank you for that. And I'm going to pass this over to Joe Johnson and let him tell us a little bit about his local market, Atlanta.
All right. Thanks, Megan. Let's talk about the market. Everyone loves Atlanta, Georgia. I mean, who doesn't love Atlanta? Atlanta has been one of the fastest growing cities since the 1996 Olympics. As you can see, there are a lot of major corporations that are headquartered in the surrounding Atlanta area. You see companies like, excuse me, Chick-fil-A, Coca-Cola, that have all chosen to make Atlanta, Georgia home. But one of the biggest projects that we are super excited about, when you talk about path of progress and you look at the 6 West project, which is a $1.5 billion mixed use facility, that's, in my eyes, the definition of path of progress. When you look at that type of business that's been put up in an area, you know there's more projects of that nature to come, and we're super excited about the position we're in and the position that Phoenix Place is positioned within the city. Now, when you come out and you talk about Atlanta, Georgia, as Dave mentioned, when I retired from the National Football League in 2004, I moved to Atlanta, Georgia, me and my wife, and we've been here ever since. Super excited about the city, love the things that are going on. As we talked about before, the path of progress is fantastic. As you see here, population, a little bit over 6 million with steady population growth, job growth, and a low unemployment rate. And then you look at the airport, which is within a 10 to 15 minute drive from our complex, which is the busiest airport in the country. And trust me, I'll attest, it is the busiest airport in the city, in the country. You'll also see that there are a number of Fortune 500 companies that have chosen to call Atlanta, Georgia home. Actually, it's the number 3 ranked city in the country that has some of the top corporations that have chosen to make Atlanta home. And one of the biggest reasons for that is you have a lot of companies from the East Coast and the West Coast that have decided to make Atlanta, Georgia home for a number of reasons. But one of the reasons is to lower their overhead and still have the big city feel. As you see here, major employers, a lot of big names to the right side of the screen: Delta, Walmart, GE, Kroger. you get no bigger than some of these companies, Porsche, Ford. But one of the biggest projects that we're also excited about is the Aerotropolis, which is $100 billion complex that houses a number of companies like Ford, Porsche, Delta. When you have companies like this in your backyard and are decided to make Atlanta home, you know there's a lot of great things going on in the city with a lot of great things to come. And at this time, I'd like to pass it over to one of the biggest reasons why a lot of you are here today, which is the investment opportunity. And I'd like to pass it along to Morgan.
All right, guys, we're going to go through the investment summary and start getting into some of the nuts and bolts of the deal here. So we've already talked about the purchase price being $14,875,000. We have the loan secured and ready to go, and we're going to be raising $7.4 million total. The minimum investment per investor is $50,000, and that's for accredited investors only. And we've already mentioned a couple of times the team here that in front of you is investing a little over 1.3 million already. So there's 6.1 million-ish left for investors to come in and join. We're going to have quarterly payments that start after the second quarter of ownership. This is going to be your 8% preferred return annually, which is a wonderful return there. The big payment's going to come at the end of the 5 years at our projected hold time when we sell. The range is going to be between 21 and 25% based on the cap rate. We're going to go through that a little bit more in detail later. And then, of course, the projected equity multiplier is going to range from 2.05 to 2.25 over the 5-year period here.
All right, everyone. So how do we reach those projections? We reach them and we understand them through a painstaking underwriting process that we do before, during, and after due diligence, all the way up to today, that we continually are updating on a daily and weekly basis as new information is provided. So when we go through our underwriting process, I'd like to explain some basics of where we're at today. The current average rent across the board for the entire property is now just at $1,050 per unit. The market rate that we have, that Samuel explained in detail earlier, of our comparison of rents in the neighborhood, project that we can achieve an average rent of just under $1,300 on these units, taking into account for classics and upgrades. Now, how are we going to accomplish our overall net proceeds at the end of the year of $475,000? That's incorporating an average of 20% economic vacancy. You have 8% vacancy across the board, plus an additional 12% of economic vacancy. Why is there going to be so much economic vacancy at this property? Well, that's because we are bringing in a new world order when it comes to this property. We're bringing in new management. We are instituting new policies. We are changing the face of the entire property, and we are increasing our rents to market or just there below for our existing tenants. So our existing tenants will be offered ability to renew their lease at below the market rate. Those who choose not to stay will be remodeled and released to new tenants. So the in-place actual average is only $1,134. The other income line item, this is actually the same number that the seller is actually bringing in, $267,000 a year in other income. So that number is exactly even with what the seller is currently bringing in. We do not project to overachieve that because they're actually doing a fairly good job at it. Are we going to do better? Of course we are. We have, if you run through these numbers in your own side time, please take the time to review them in detail. But ones that I really want to focus on are insurance. We have an insurance budget of $93,000 that has been put in place and secured with a bindable quote by our insurance providers. And we are still working through that process to determine if we can lower that, and if so, by how much, when those new roofs get put on the property. So that number could go down. Our real estate taxes. So we went and approached the local municipality, had conversations with them about the purchase price and what our taxes will be next year, because we don't know we know what they are this year. We don't know what they will be next year. And we increased the taxes by 80% from their current in-place amount. So not, and that number was discussed with the local assessor, and they found that to be a very conservative number and very unlikely that we hit that number in the first year. Our payroll budget is $200,000 for this asset. Why is it so much? Which is just under $1,400 per year per unit in payroll costs. National average is right at around 12. Well, ours is over that because it's a value add property, because we are going to have to, and we want to afford to have extra effort and the ability to pay bonuses to our on-site third-party management staff who will actually live on-site. And part of their benefits package is to have our full-time on-site manager not only work at the property, but they actually also live at the property. So one other thing to take into consideration when we're thinking about payroll, our management fee has actually been negotiated down to 3.5%. It's not 4%, but we included 4% because there's always added on expenses for bookkeeping, accounting services, and little budgeted line items that a lot of people don't necessarily take into consideration. The utility expenses are simply fixed on the water, sewer, and trash. And then at the end of the day, we'll pay our debt expense, and we will have $475,000 in the first year left over to be able to distribute out to our investors. Now let's fast forward to year 5. We will have now flipped all of the units. Every single unit will have been touched, invested a minimum of $3,500 into it, or up to $16,000. The average rents will only be at that point, our projection of $1,450 on average across the entire board and the portfolio, which is only $150 and some change above where the current market is. Then we have an 8% economic vacancy baked into year 5, which is a very conservative number in comparison to what the market rate physical vacancy and economic vacancy is for Atlanta as a whole, which is approximately 5%. At the end of the day, we also believe we'll overachieve this, but we've only budgeted for 36 months worth of interest only from our debt. Our debt is, in this estimation, is based upon a 6.25% interest rate. If we were to place that debt on the property today, it would actually be slightly lower, closer to 6.09%. So we've added an extra buffer on top of that in case interest rates go up. It's all based on the 10-year. So as we get closer to close, we will constantly daily be monitoring the 10-year treasury note, and that will be determining whether it's at 6 or 6.2 or 6.8 or 6.25. But we've over budgeted for our debt expense and overestimated for our principal pay down because we believe we'll have a longer period of principal of interest only period. And feel free to add any additional questions into the chat if you have any about those numbers. So we won't cover every single one of these pro forma assumptions, but essentially the main line items in this spreadsheet and our assumptions are here in writing. So they're explained in detail to you. The one thing that I really do want to focus in on again is our assumption for property taxes to go up by 80%, an 80% increase based upon the current in-place property taxes. You'll also notice that, that our management fee still says only 4%. We budgeted for an additional expense for turnover in addition to spending all of the money on the first few years. After the 24th month, we will begin reserving and spending money to return over those units again and again, and that's budgeted to be right at $135 per unit. So take some time to review those and let us know if you have any questions along the way when you're reviewing it on your own time as well. Back to Morgan.
Well, once again, there's the QR code. If you guys are ready to start the investment process, you can go ahead and do that. If you want to continue forward, we'll have some more opportunities later on, of course, to scan that code. The next page we're going to get into here, actually we have 2 pages that we're going to go through that are our investor projections. So this is going to give you a great breakdown and we're going to be able to explain what the difference is between the cap rates here. So page number 1, what we're looking at right now is based on a 6.5% cap rate. The next page we're going to go to is a 6% cap rate. Currently, the average cap rate in Atlanta is 5.02%. So we are being extremely conservative. You hear that number over and over and over again in this presentation. The reason is we always want to over or under promise and over deliver. So these are, great tools to look at here. If we look at this page, this is going to be based on a $100,000 investment, just for real simple math. Year 1 through 5 in the chart there, we're going to talk about the 5 years of hold time that we're going to own the property. Cash flow and cash on cash are essentially the same item, just broken down in percentage basis or dollar basis as well. We've already talked about the quarterly payments. They are going to start after the second quarter of ownership. So that's why in year 1, you're going to see the cash on cash return at 5.92%. It's going to be the least amount throughout the years because we're not starting those distributions immediately. Year 2, we come up to 8.6%. Year 3, over 10%, and so forth. So it averages out to be able to deliver that 8% return, the preferred return over those 5 years. The bottom line there in the dark blue, you can see the cumulative return. That's, again, based on your $100,000 investment in this scenario. On the right side of the page there, this is the fun part. So we've got the total cash flow that comes from your 8% preferred return. The next line there, projected equity at sale, $62,160. So this is going to be at the end of 5 years when we sell the property. That's going to be your big payout at the end of the day. So bottom line, if you invest $100,000, basing it on a 6.5% cap rate here, then you're looking at a $205,000 almost return. If we go to the next page, we're going to see the same chart based on a 6% cap rate. So all the numbers are going to be the same on the cash flow side, and the projected value on the other side there on the right side of the page for the equity at sale is going to increase to the $81,000. So if for a $100,000 investment, you're going to get almost $225,000 in return. And that's a wonderful investment, if you ask me.
Hey guys, so tax benefits. People always ask during these presentations, are you guys doing a cost segregation study? And the answer to that question is yes, we're doing a cost segregation study. So just in case you're not familiar, quick 10,000-foot explanation is if you go out and buy a rental house, the government says you can depreciate the cost of the building over 27.5 years. Buy an apartment complex, it's the same thing. You can depreciate it over 27.5 years. What a cost segregation study does is it takes the building, and instead of looking at it as 144 units, it changes it to 144 units with 144 refrigerators, with 144 stoves, with 144 dishwashers, with 144 water heaters. Each of those things I just mentioned, you can depreciate them over 5 years. And so we run these separate depreciation schedules, and what that winds up doing is it gives you a paper loss. And I do just want to reiterate, that's a paper loss. We are not anticipating any losses whatsoever on this, but you should get a paper loss in your first year equal to about 40 to 60% of your investment. So if you're investing $100,000 in this deal, you'll receive a negative K1 that'll give you a write-off in your first year, somewhere around $40,000 to $60,000. So that's one of the little tricks. The IRS says it's favorable towards real estate investing, and if they're going to offer it, we're going to take it. So there you go. Sam, why don't you go to the next slide?
Very good. Thank you very much, Charlie. The investment process, the fun part. The person that invited you to the webinar today should have sent you a link to the cash flow portal. If they did not, Megan and Morgan showed you the QR code. You can scan the QR code and it'll take you to the cash flow portal. Once you get to the cash flow portal, you'll create an account and then you'll sign in. Once you sign in, the investors will pop up the offering documents and you'll review the offering documents and make a commitment through the cash flow portal. Then you'll e-sign. Once you e-sign, It will then go to Megan and Morgan, and they will review the documents, confirm the accreditation status, and provide the funding instructions, either a wiring instructions. At that point, then you will want to fund the deal using the investor portal, and you can send the funds by either wire or ACH, which makes it convenient. As you heard earlier, we're looking for 7.4, but the general partners are putting in 1.3. So once the $6.1 million funding is completed, we are closing that funding, and the deal will be then closed. The Phoenix Place will then schedule to close in October of 23, which is next month. It's coming up soon. Next slide, please. Frequently asked questions. This is fun. What is the time horizon for this investment? Well, we're set to close approximately mid-October. Shares are investments typically go pretty quickly, as we said before. So please register on our portal and commit your investment as soon as possible. How will the profits be distributed to the investors? As you heard from Morgan earlier, this deal has a preferred return to the investors before the executing the sale of the property. After the 8% preferred return, the profit is then split 70-30. Limited partners get the 70% and general partners get the 30%. Distributions begin after the second quarter of ownership. How much are the general partners contributing to the deal? Well, you've heard from Lee and you've heard from Morgan. We are investing as a team $1.3 million into Phoenix Place. And as an example, a lot of general partners do not do this. We are very excited about this deal, and our general partners, including myself, are investing money into this deal. And as you can see, it's $1.3 million. What are the investor requirements to invest in this deal? Only accredited investors can invest in this opportunity. Review the SEC qualifications for accreditation here. I'll give you a little insight. What qualifies someone as an accredited investor? According to the SEC, an individual accredited investor is anyone who has earned income of $200,000 or $300,000 together with a spouse in each of the last 2 years and reasonably expects to earn the same for the current year, or $1 million in assets, not including your home. That's the simplicity of it. There are other qualifications, and you'll need to go to the website to really find out. If you do have some additional questions on the qualifications, you can reach out to either Megan or Morgan on this. What is the minimum amount I can invest? $50,000 is our minimum amount. Now, if you don't have $50,000 and you want to team up with another accredited investor, and you want to put $25,000 down, another person wants to put $25,000 in, you can probably create a LLC and put $50,000 as a minimum investment. Can I invest money from my IRA? Yes, you may, and also your 401k. You'll need to set up a self-directed IRA, and that's a separate company that you will transfer your money from your IRA or your 401k and your self-directed IRA. And again, Megan and Morgan can help you do that also. Is due diligence complete? Well, you've heard from Dave that we all as a team walked the property for 4 days, and it was a very complete. We had over 40 subcontractors show up the job. We had a proposed property management company come out, and they walked every unit. Both Samuel and Colby walked every unit, 144 units, and all the property grounds, every location. I walked the grounds completely, so it was completely a very good job by Dave and his team. Back to you, Charlie.
All right, guys. So this is the last slide in the deck. After this, we're going to open it up to a Q&A. So once again, there, if you guys have questions, please feel free to drop them in the chat. Hopefully you got the vision for the property here and for the opportunity. Once again, we are very excited about it. Couple of last little thoughts I wanted to touch on. Again, I've been doing this for a very long time. People ask me, how do you know if a deal is a good deal? You know, there's lots of stuff out there. How do you know if a deal is a good deal? So what I talk about is we look for properties that check boxes. Okay. And so Property's located in a growth corridor. There's a brand new elementary school that our tenants are going to be sending their children to right there. There's another brand new school nearby. I think it's a high school. So we've got some great infrastructure going in place there. You heard about the real estate development projects that are going on. If you're standing at the very front of our property and you look kind of catty corner out, there's a house for sale for $999,000. So you literally have $1 million homes right here in the same area. And so it checks, those boxes that we talked about. Last thing is this, Delta Airlines is a publicly traded stock. It's the corporate world headquarters is located about 10 minutes from the complex, but you can go out tomorrow and buy $100,000 of Delta Airlines stock. Number one, you won't get the benefit of the cost segregation that we talked about a second ago. But number two is there's nothing you can do to make the value of that stock go up if you buy it. There are literally 300 things you can do to make the value of this apartment complex go up. We have a very detailed business plan in place to execute. And once we do that, the odds that once we, you saw the pictures going from the orange and peach, to the blue and white with the very nice stainless steel appliances on the inside, there's probably a pretty low likelihood that the complex is going to go down in value after we do those things. So we think we have a great plan in place to increase the value, to add value to all our investors, to make a much better neighborhood for the tenants. And so we're looking at this as a win-win-win. Last thing I want to touch on, which we had one slide on it in the presentation, and we could probably spend more time on it, but it's this team. It's the people that you're seeing right now on the Zoom call. This is my 5th deal I've done with Lee and Megan Fjord. They are awesome as asset managers, very detail oriented, all over their stuff. Dave Carlson has built apartment communities for the last 30 years. He's running your CapEx. Can you imagine anybody better to oversee a CapEx program than Dave? He'll do a great job. Sam's another long time. You got two GCs you're looking at right now that are very detailed in the construction industry. Morgan and Megan are as sharp as they come. Joe Johnson, former NFL football player. We got the NFL in the house here tonight, guys. Joe is unbelievably well connected in Atlanta, and this is what he does. He renovates properties. So he's going to be our boots on the ground. We're so excited to have him on the team. And so, yeah, we just feel like this is an absolutely phenomenal opportunity. Please scan that QR code if you have not done it already. And then you're going to hear from whoever invited you tonight in the next 24 hours, and they're going to follow up with you. Ask any questions if you have them. Spots are absolutely going to fill up on this one. The last deal we did, everything filled up, and we had people who came in and said, "Hey, I've got some money to invest," and it was done. The last thing you want to do is turn people away, but we had to do that on our last deal. So please don't miss out. We would love to have you involved with us. And yeah, that's it for tonight, guys. So last slide, and take it away, Megan.
Thank you so much. Everybody did such a great job here. Like Charlie said, if you're ready, go ahead and scan this QR code and start your investment. But I've been keeping track of the questions in the chat box here. So I'm going to go through them in, not in particular order, but as kind of like from beginning of the project to the end of the project as I see it, and how those questions fit in. So this was actually perfect timing, as Charlie was just talking about, again, the team, our experience, our the years of knowledge behind this. Somebody is asking about our team's track record as syndicators, how many deals we've done together, what have been the average returns, have we ever missed our target or had to do extra CapEx or raise extra money. So I can just kind of answer the first part of that. We all have different levels of experience. We've all been doing this for different amounts of time. Charlie, you said you started in 97, correct?
96, yes.
96. We know that Sam has been a limited investor, a limited partner investor on 14 deals over the years, and now is on the general partner side. Lee, tell us about how many deals you've done now with Megan, and maybe you guys can expand a little bit more on the track record and missing goals or anything like that.
So full cycle deals are really what matters, as well as where the current projects that you are ownership on and where are they at in the process. First of all, I believe Charlie's been full cycle on maybe a dozen or 15 deals.
14, yeah.
14 deals full cycle from purchase to sale. Of those, Charlie and I have done 5 total deals together, one of which went full cycle, and one of which I did before I met Charlie that also went full cycle. But we'll focus on the one that we did together so far. We bought it for $2.6 million. We put about $400,000 into it. So let's call it an average of $3.1 million into it. We owned it for 24 months. We sold it for $4.4 million. It took for us to acquire that asset $600,000 in equity to purchase the property. So we turned 600 into $1.8 million after all expenses paid, and a large portion of that money that is being, not all of it, not nearly all of it, not even quite half of it, but a large portion of it is coming from the proceeds of that sale that Charlie and we are investing directly into this project. That's where that 1.3 million, a portion of it comes from.
Yes.
So
And I would just like to mention too, that this is a 70-unit apartment complex that was managed by the same property management company that we intend to use on Phoenix Place. So we have a successful track record as well with this property management company. They just got us out of this other property. It's successful. It was a 5-year business plan that we executed in 2.5 years.
Yep. So if you do the math, we essentially performed a 200% return on investment over a, call it right at 2 years. We only had that property for 2 years. So an average annual return of 100%. Now that's not what is realistic or what we are projecting for this particular project, but that is a deal. It's called Stonebridge Meadows in Farmington, Missouri. That was Charlie and my first deal. We're under contract to go full cycle on our second deal, the next one very soon. It's called the Reserve at Spanish Lake. Now, the other question is, how are our current deals doing? Yeah. We have another deal, the first large-scale 506C syndication is called the Park Hills Portfolio. We have hit our pref since day one, distributing our to all of our investors consistently quarterly distributions every single quarter. And we've never done not that my knowledge, I have never done a capital call on any project. And the way you avoid that is not over leveraging the property, not borrowing all of the CapEx, not taking out extremely risky debt that is 85% leverage or 80% leverage, or adding additional debt to the top of the property by borrowing your reserves. So no, we've never done a capital call, and we have actually only outperformed our numbers ever.
Can I add to that, Lee, real quick? I know we've got a bunch of questions out there. One of my first deals that I invested in was on a deal that, and I've been involved in 13 deals. This is going to be my 14th, as Megan stated. But one of my first deals was in a deal that Lee and Megan put together about 2 years ago, and that was the Park Hills deal. I did not know Lee. I did not know Megan. It looked like a great deal for me, and everything that, and I invested quite a bit of money too. And by far, out of 13 deals I've invested, this is one that has never missed its dividends. I've gotten their dividends on the money each and every month. And I got to know Lee about 6 months ago on another deal that I invested with him. He was helping me, through the portal, and we started talking, and he invited me on to this next deal. And so he is correct. It's one of the best deals I've invested in, the Park Hills. So there you go.
Thanks, guys. This is a quick and easy one for you, Lee. What is our cap rate at purchase?
Right at 6. So the in-place cap rate at purchase on this property is slightly above the market rate of 5. In East Point, the market rate is about 5.57%. The market rate for Atlanta is 5.02 approximately, but we're buying it just above the current market cap rate.
Another one is that our current occupancy is over 90%. How do you do turnovers if the tenants don't move out as planned?
I love when that happens. We actually have that problem at one of our properties in Arkansas where we had so many tenants renew their leases. We weren't able to start our value add business plan soon or quickly enough. It was actually, I mean, it was perfectly fine because we're still renewing at new high rents.
Right. We were renewing the rents on our classic units they already lived in for the market rate. So the tenants were staying at the market rate, which is best. It's like we're achieving the business plan, but we're not having to spend the money or have the vacancy risk. So it's a win-win all day. We always approach the tenants and offer them to renew. We offer them to renew at a higher rate. That's, we're going in on day one and doing exterior renovations. We're making the property look nicer from day one. So we are investing in the community. The tenants get to see that. They see we're putting in patios, we're putting in dividers, there's brand new roofs. So there's justification there as well. Plus the market, the market has that, wherever you look, like on our comps, everywhere else is charging more rent. So
their only option or their best option is to stay at our rates because we keep them slightly below market across the board. And they love when we bring in the new management staff who live on site and become their neighbors. It's really, really a win-win, approach. We have budgeted to update every single one of the units, which will happen at some point over the course of 3 years or more. Eventually, everyone's going to find a reason to move. But it will happen.
Mm-hmm.
In the meantime,
Piggybacking on that. Oh, sorry.
In the meantime, it'll just earn interest.
The CapEx money.
Yeah.
I was going to jump in real quick and say the same thing. Any of that money if we're not doing the turns, that money is sitting there as reserves, essentially earning interest. So that's not a bad thing at the same time as we're raising rents without doing any of the work. So that's all good. And Lee, did you mention anything earlier about our appraisal?
So we did get our appraisal in. It was slightly higher than the purchase price. I don't want to give an exact number, but it was a little bit higher.
Good bonus there.
Yeah.
So piggybacking on to that one regarding vacancy, have you done a worst case scenario underwriting if, God forbid, we have a 50 to 60% vacancy? Can we still stay afloat, pay our debt, all of that sort of thing? So I will say that if we're with 144 units, 50% of the people move out, that's a big mass exodus. But Lee, I know you have a great answer for this.
So our numbers, our current in-place numbers, which allow for a $475,000 year one distributed cash flow to the investors, incorporates a 20% economic vacancy. Just want to throw that out there. Then in addition to that, our break even is around 65% economic occupancy. So we would have to reach 35% of the units not paying rent, which, let's all be honest, is not always like if the worst of times of COVID, people with, not paying rent, I'm not going to pay my rent, whatever. Well, even still, we were buying assets and running assets during COVID, and we never reached below 90% economic occupancy on any of our assets, not a single one of them. The only way that, especially in a high growth market with a high demand, the only way you could ever get to 65, which is our break even, and would basically mean that we would still meet our debt expense, but we just wouldn't be able to distribute any cash flows to our investors. And we have $145,000 in reserves on hand at all times, just in case that were to ever happen. So the answer is 65%, I guess, is probably the last number.
Long and short of it.
Long and short of it, it's 65% economic occupancy.
For
And-
break even.
Yeah, and we've never gotten below 90 on anything.
Fabulous, thank you. Next question, actually, so we're gonna have two kind of about LPs and the investor relations side of things. First one is, do the LPs get a K1 at the end of each year?
They do. Yeah.
Charlie, you
That's
want to
probably
take
a
this?
good answer, Charlie.
Yeah, so so there's going to be an entity, an LLC entity is purchasing this property. That LLC entity will file a tax return every year. You, as a limited partner, will own a little slice. It's like owning shares of stock almost in that LLC entity. And so you're going to get it's called a K1, which comes from IRS Schedule K1. They call it a K1 pass-through. And so the income or losses will pass through onto your personal return.
Perfect. And then the follow-up question to that, I can actually answer this, is how do we plan to update the LPs during ownership? So my brother Morgan and I, and Bethany as well, his wife, we run the investor relations team and the marketing. So it is our plan to do monthly newsletters to all of the LPs, let them know what's going on at the property, all of our wins, all of our progress, all of our expenditures, how the rent rates are going, how our vacancy is doing. So you'll get those monthly via email. You'll be invited to a once annual event where the whole GP team will be on site and all of the investors are allowed to come and network and see it for themselves. So we'll host that every year. You'll have access to your investor portal at all times, so you can see what's going on, and that's how you'll get your ACH distributions when it's time for that. So lots of communication going on with us. And then of course, you'll have direct access to your sponsor, whoever it was that invited you to come to see this webinar and invest in this project, that you can reach out to and ask questions at any time whatsoever. Let's see, the next one is, and thank you, Samuel, for already answering this in the chat box, but what is our acquisition fee? That is a total of 4%, not as high as the usual 5% that somebody guessed.
Yeah, there's no disposition fee, no finance fee, no other fee. We just charge the acquisition.
That's right. So I think I've hit everybody's questions here in the chat box, unless anybody else has something to throw in. We sure do appreciate you being here. We hope that you will go ahead and scan this code and start your investment or ask questions to your sponsor. Oh, we have one more. Let's see. Since 8% preferred return, where'd it go? Oh, there it is. Being held for 2 quarters, will the LP be made whole in the 6th month? Okay, so regarding the quarterly distributions being started in the 2nd quarter of ownership.
Yes, the answer to that is we will distribute out the available cash flows for the first 6 months of ownership. So we acquire the asset, and 6 months later, we begin distributions, and the 8% preferred return does accrue during the lifetime of the investment. So when you see the 5.74 or something along those lines number that is distributed, we estimate to distribute in year 1. Well, before our team begins to earn any income, any returns for our time, we have to catch you up, and that return has to get all the way to 8, and then after 8 is when the split begins, and the split is 70-30. 70% of the additional returns thereafter go to you, our LP investors, and only 30% go to us, the active owners and managers of the asset.
Wonderful. Okay, and then one last, oh, no, 2 more. What if you're not accredited? I'll let Morgan answer this one.
There's a few options for that. I mean, this is set up as a 506C, so we only accept accredited investors. Some of the other avenues to go if you're not accredited is if you can partner with another investor that is accredited, create an LLC together, and invest into this deal as a single entity. So there are options, and if you want to get more into depth, you can absolutely reach out to us, and we'll try and help walk you through that process as well.
Hey, Morgan, so don't mean to sidestep you, but we actually updated from the SEC attorney yesterday that that is not an option. All accredited investors partnering on an LLC have to be accredited.
Yep.
Understood. Sorry.
No problem.
So unfortunately, what we would recommend for anybody who's not accredited is to create a substantive relationship with the person who invited you here and be ready for our next project that comes available that would be a 506B syndication, where we would be able to bring in non-accredited investors up to 35 people. So, and we do both. This team does not only 506C syndications that are only for accredited investors, but we also do 506B syndications where we allow ourselves to be able to reach out to our immediate network and bring in up to 35 non-accredited investors. So reach out, establish a relationship with us, make sure that's in place, and then we can bring you into our next 506B.
Perfect. And then last one, and I think this ties in perfectly to the SEC conversation you just started. One of our guests here has LPs that are interested in investing. He's wondering if he can apply interest to their projected returns as a finder's fee, which is probably a no.
Generally no. If you are a licensed broker dealer and carry that license through the SEC, you are allowed to earn income by placing debt or placing equity into syndications. But assuming that's not the case, the answer is no. You're not able to charge a fee, earn a fee directly for raising capital for deals under generally any circumstances. Team members are not allowed to be compensated directly for only capital raising. Each person on this team has to be bringing with them a set of skills, time, effort, and risk of capital and signing on debt efforts in order to qualify to be a part of this team for our deals. So I don't think there is a way to be able to do that unless you're a licensed broker dealer. At all. But we'd love the referrals of your friends and family, and we will take great care of their capital and make sure that they are alongside my family's money that we will be also investing into this deal.
Okay, and then one last one. I know AJ, I think one of our general partners answered this in the chat box you may have missed. What are the out-of-pocket investments the sponsors and GP partners are making? So I think if I'm understanding this question correctly, as we said, cumulatively, we are investing 1.3 million out of our own pockets. That has gone to at-risk capital, the earnest money deposit, to inspections, due diligence, all sorts of things like that. And it'll be wrapped up into the investment as well.
Mm-hmm.
Anybody else have any other way to answer that?
The only other way I've heard it answered is that you subtract the acquisition fee out of the 1.3 million. So someone might argue that the quote out of pocket money is removing the acquisition fee, which is earned at the closing or post closing. In which case it'd be approximately 1.3 minus 600, so call it $700,000 of true out-of-pocket money that is not offset by acquisition fee. So if the acquisition fee were equal to what we're investing into the deal, then we would have zero out-of-pocket money, but that's not the case for us.
Right.
Fabulous. I think we've gotten to all of the questions. So again, thank you so much to everybody that was here. And reach out if you have any additional questions. Otherwise, we hope to see you in the investor portal. Bye, guys.
Thank you so much, everybody.
Thanks, guys.
you.